Good afternoon. My name is Scott Richter. I'm a director at large for the Market Technicians Association, and welcome to the 2016 Symposium. I'm here this afternoon and have the pleasure of interviewing Dr. John Nofsinger, who is the Seward College of Business and Public Policy Chair at the University Alaska Anchorage. So he's not only an academic, but he's an author. He's published several popular books on behavioral finance. And John, I'm glad to have you here today.
Well, thank you very much.
Nice to be here. Behavioral finance is really starting to get some traction. We as technicians think we had a little bit of a hold on it. But why don't you tell us how your work involves behavioral finance and what your message is basically?
So I would say that there are several aspects to that. The aspect for technical analysis is that I feel that technical analysis it's a very old profession, obviously, analyzing the data from long ago. All the way up until modern methods of doing it now. But I felt that what it's missing is a solid theoretical foundation on why patterns and things happen the way they do. Why do strategies work and then don't work? Why do other strategies work? Why does any strategy work? And I think the potential for that is behavioral finance.
And how does behavioral finance help us, if you will?
So I think that for individuals, we all have lots of cognitive errors and psychological biases that we follow quite a few times. And the reason we have that is because finance decisions are hard. They involve uncertainty and risk. So we never have all the information. We just got to make a decision. And the part of our brain that helps us do that is the emotional side. And because of that, it leads to some of these biases that we have.
So we're not purely rational. We're not using a purely economic model. You say the emotions figure into this highly.
If we could know everything before we made a decision, it would be a perfectly rational decision.
Okay.
So we have all of these biases that we have, and oftentimes they can aggregate and impact prices on the market. So that's the two aspects I was talking about. One, can they impact the market? And if they do, then technicians might have been able to find these patterns all along before we even knew about the biases.
Okay.
The other aspect of, hey, it's my problem, it's my cognitive error, I want to know about it, and how do I fix it? So that has been largely my message in some of my work and in some of my books is, these are the cognitive errors. These are what we do all the time. I like to put them in an example like, a used car or something very familiar to all of us.
So how would a used car give us a behavioral example?
So here's an example. We have a representativeness bias, which just means that there are two objects. We know one very well. We know all its characteristics. The other characteristic we don't know very well, but they seem like they should be similar, so we transfer the characteristics to the thing we don't know. Example, there's a car. I don't know much about engines, but I can see that the car is clean, it smells good. I assume then the engine is good.
So we extrapolate that.
Extrapolate those characteristics because they seem like they fit together, right? Every used car salesman in the world knows that, right? So they don't bother fixing the engine, they just wash it and make it smell good. So that's what happens to us in our own decision making. I don't know what the future holds in the stock market, but I know what the past holds. And we tend to do a lot of extrapolation. If you ask people which stocks are going to do well in the future, highly correlated to the stocks that already did well. Is it going to be a bull or a bear market coming up? Depends on what just happened. So we fall into this trap. Similarly, we fall into the trap that we think a good company is a good investment because they sound like they should be the same. But a good company, I want to work there, great profits, growth, great chart pattern, however you want to describe a good company, they could easily be overpriced and not be a good investment.
Let me ask you a question about that. So you're here today and the last 2 days in presenting, and the majority of folks here are institutional investors. And the question would be, do institutional investors seem to get caught up in these errors as much as, say, a regular individual would, a retail investor would? Or have they lived enough lifetimes with other people's money where they can start to eliminate some of these errors? What has your research maybe borne out on that?
So the answer is yes and no.
It's not the answer I wanted. No, but
we do learn. We can learn. So the more experience we get, and a professional investor is going to get more experience because they're doing it all the time. And so they start to see things and they start to recognize and adjust. And so in that regard, they can avoid many of them. But they're also people, right?
Right.
And they affect it the same way. And in my presentation today, for example, I did have a lot of studies that shown that professional investors can fall into this one trap. It's a trap where, the fundamental theory of finance is that expected return and risk are positively correlated. If you want higher return, you got to take higher risk, right? Fundamental theory.
Right.
But there's a lot of studies that show if you start asking the professionals these questions about how do you like this company and rank these by returns and then rank these by risks, they actually are not thinking about that risk-return relationship. They fall into the trap of what I call the better framework, which is, I like that company better. What does better mean? Higher return, lower risk. Wait a minute, that's not the theory of finance.
Right.
But even professional investors fall into this better trap rather than the risk-return framework that finance is built on.
Okay. Well, let's wrap up with, can you give us a couple of bullets on how do you get better, if you will, as an individual, as an organization, with overcoming these cognitive biases, these traps, if you will? What do we have to do from a mindset perspective? What might we have to do from a psychological perspective to try to get over that hurdle?
Well, there are some things we can do. So I mentioned experience. Mm-hmm. So we can get experience quicker by going ahead and trying to learn what the biases are, right? So get decades ahead by learning all the biases, and there's a lot of great outlets for doing that.
Okay.
And then another thing that we need to do is to try to learn how to identify them in others. Because the more we think about the biases and the more we try to identify them and what's going on, the more we'll see them in ourselves.
Okay.
And then the next thing we need to do is we need to control our environment, okay? So, which means when I go on a diet, I don't keep a jar of M&Ms on the counter, right? I control my environment.
Okay.
We need to do the same thing in our investments world. If you seem to succumb to a lot of overconfidence and a lot of fast trading types of biases, well, then maybe you should say, I'm only going to trade on the 15th of the month or something, and that way I'm not running in and out all the time, being driven by the last news article or the last thing I read on Twitter, but I'm actually trading on information that I have validated and find is sound by slowing down a little bit. Okay. So whatever the biases you seem to have in your life, control your environment in such a way to try to minimize them.
I just have one follow-on to that. Does journaling or any type of other recording of what you're feeling, what you're doing, help an individual or an organization meeting as a group to discuss these sort of things? Advance the ball at all? I
think journaling is a really good idea, especially when negative things happen. Okay. We have a tendency to remember every three-bagger, every great stock that we bought, right?
It's called selective memory.
Right. We don't need to reinforce that.
Right.
We need to reinforce the ones where we made a mistake, analyze maybe how that mistake was made, and be able to review that periodically.
So we've got to be pretty honest with ourselves about our mistakes, which is not easy to do.
That's why it's hard to learn.
Okay. Well, we'll wrap it there. Dr. Nofsinger, thank you so much.
Thank you very much.
For speaking to us, and thank you for watching. There's several other videos from the 2016 Symposium, so please tune into those if you haven't already, and hopefully we'll see you at the 2017 Symposium. Thanks again.